Great. Great last presentation by the folks at CNFA. So now we're going to switch to another presentation I'm very excited about by John Kashangaki, who's the Deputy Chief of Party for the Kenya Investment Mechanism. John's going to talk about their experience catalyzing investment for enterprises in Kenya. John's background is he's the deputy chief for the Kenyan investment mechanism that's been implemented by the Palladium Group. John has over 20 years of experience in private sector development with a key focus in market research, business planning for projects and enterprises in East Africa. So John, we're really excited to hear your thoughts. And so I'll turn it over to you.
Great, thanks, Peter. I hope I can be heard, and it's really good to join this distinguished panel, to be part of the group sharing experiences in our work on the continent and specifically in Kenya. And as Peter mentioned, I'll be sharing the experience of Kenya Investment Mechanism, which is a 2-year-old program now, established and funded by USAID and being implemented by the Palladium Group. And really our focus, I think we've heard some interesting experiences that cut across the challenges that processors face and working directly with companies. Ours will be focusing very specifically on a mechanism that is geared and targeted towards helping increase access to finance for companies. And basically transforming the market system in the country to make it more self-reliant in the long term and sustainable, so that companies can raise capital in a more efficient and effective market space. So my presentation basically quickly give you an overview of the program, how it's structured so that you understand the mechanism itself, the thinking behind it, what we've achieved so far, talk a little bit about COVID and some of the responses to COVID that we had, and a couple of examples then of some transactions that have closed and emerging lessons. So as mentioned, Kenya Investment Mechanism, it's a 5-year activity to end in 2023. So we've been operating now for 2 years. There's special consideration given to investments that empower women, employ youth, and support smallholder agriculture. We have a number of partners. The initial funding came from the Women's Global Development Program, Prosper. The objectives of the program are to mobilize $400 million in finance and investment to specific sectors, and I'll talk more about those sectors, to structure 15 strategic partnerships that will unlock capital at scale, to ensure that at least 1,600 transactions are funded, supported by business advisors and or dispersed by financial institutions, to support improved policy, at least 25 enabling environment, finance, and investment policies for key sectors, clean energy, livestock, dairy, and horticulture. And we also manage the Development Credit Authority, which some of you may be aware is a US government scheme that really helps to provide guarantees through financial institutions to unlock capital for specific sectors. So we're working with several financial institutions that have DCA agreements. The approach, basically, we look at both the supply and the demand side, and we have a structured incentive scheme, which I'll talk about on both the supply and demand side, which is targeted at leveraging financing and creating a more sustainable market system that can mobilize capital for the private sector medium to long term. So on the demand side, we work with business advisory service providers, and we have subcontracts with them. In our first, basically 2 years, we had 20 companies that were engaged. We have now brought on board an additional 20, so we have a total of 40 companies. Some have dropped off, but we have basically 35 companies that we're working with under subcontract. And these companies are paid success fees for transactions that they're able to take to market and actually get financed. And they're basically paid a percentage of the size of loan or financing that they're able to mobilize. It's mandatory that clients also sign up to pay a certain portion of the fee. The incentive really is not the full amount that the company would need to cover its costs. It's really a sweetener, and it's really targeted at pushing some of these advisory firms that previously were not working in these sectors to look at deals in these sectors and allow them maybe to offset some of the costs of the initial work that was required to understand these sectors. Over time, the aim is to reduce these success fees so that a market fully pays for services that are provided by the business advisors. Just in the picture, one of the companies that has received support is a fish farm in Lake Victoria, which is aiming to be one of the largest fish farms in Africa. Currently is one of the largest on the continent. On the supply side, we work with, again, we have agreements with banks, non-bank financial institutions, microfinance institutions, and some impact investors to, again, incentivize them to look at deals in our target sectors. And they get paid, again, a percentage of the transaction ranging between 1% and 3%. And the aim is to slowly, gradually reduce the incentive over time as the financial institutions begin to increase their lending and get to understand these sectors more. They will be able to continue to do it on their own. So basically, the overall approach is we have transaction advisors on the demand side. We do provide capacity building support to them as well. We do training and other kinds of support to help them to move into these markets, hands-on technical assistance. Then we also have the financial institutions on the other side. We provide performance incentives, and also working with our DCA, we provide support and risk mitigating tools that would help structure some of these deals. We also provide capacity building and training to financial institutions, helping them design products, train their staff to understand new value chains, understand the opportunities in these value chains and how to structure deals. And really the whole aim is to push both from the demand and the supply side, players in the market to look for opportunities and structure opportunities in sectors that have previously not had significant amounts of capital. Just by way of example, in Kenya, for example, if you look at bank lending to the agriculture sector, less than 5% of the total lending goes to the agriculture sector. And we know that agricultural sector accounts for at least 30% of GDP. So the idea is to push financial institutions to move into these sectors, help them to understand the risk and increase capital mobilization to players in these sectors. So looking at the key sectors of the 400 million, we have a target of about 17 million for horticulture, in dairy about 90 million, livestock 50 million, and other sectors. Some of these other sectors include Prosper Africa, which is sector agnostic. It's really companies that have some element of a US nexus, either through trade or actual shareholding. Energy and infrastructure, health, water and sanitation, as well as education, workforce development, trade and environmental tourism. These are new sectors that have come in in year 2 that we're moving to get financing mobilized in the next two to 3 years. What has been our experience so far? If you look first quarter, nothing mobilized. By quarter 3, we had about 6 million in 2019. And we've had a very strong experience quarter 4 and throughout 2020. And we've been able to mobilize as of, the figure there is July 30th, but as of September 30th, about 121 million US dollars, both from the business advisory service providers and the financial institutions. Roughly about $70 million has been mobilized by advisors, 47 million by financial institutions, and then direct KIM facilitation, about $5 million US dollars. Our target to women and youth, specific amounts, 20 million for women and 3.4 million to youth. This is data we're looking at closely. We're always trying to see how we can do better, and we're really looking at how we can improve on the youth element. Some of it is the challenges. Youth-owned businesses are very early stage, and we're trying to see how best we can scale up financing to youth. But when we look at employment across both women and youth, the companies that we're supporting, significant employment. I don't have the data with me, but there is significant employment across women and youth. We're also seeing that, interestingly, many of the companies, because we're focused a lot in our first 2 years on companies in agribusiness, many of the companies have backward linkages to smallholder farmers. And when we look at the companies that we have in our pipeline, over 5 million smallholder farmers are connected to these companies, 121 companies that we're working with. And when we look at our pipeline, we've been able to generate a pipeline in two years of about 700 million US dollars. And out of that, 625 million are actually under engagement by one of our advisory companies, and they're being helped to raise capital. So we're quite encouraged by these results, and particularly the ability to work with multiple partners and really move and incentivize the market to mobilize capital at scale. In relation to this presentation, processes account for 30% of our total pipeline, and in terms of actual capital mobilized, is roughly about the same, 30% of capital mobilized. What has also been interesting for us during this very difficult 2020 is how, because of the pipeline that had been developed, in spite of COVID, we've been able to see companies raise money. But that said, there were a lot of challenges faced by many of the companies in our pipeline, and I think that was alluded to in the earlier presentation. Supply chains were disrupted, companies lost significant income streams, banks and other investors slowed down on providing any finance, very risk averse. So we needed to really look at how we could support our partners to continue to be active, to continue to engage with the companies they were working with. Many of them buckled down, didn't look for new clients, just really focused on the companies that they had and really looked to see how they could support them, introduce them to COVID relief funds. We, as KIM, also developed strategic partnerships with 2 COVID relief funds that came into the market and introduced them to our advisors. The support that was being provided, many of our advisors had to reorient their support and focus a lot on just helping companies to raise a bridge finance that they needed just to survive in this difficult period. For example, actually the fish farm that we mentioned, a growing, fast-growing company, but during this period faced a lot of challenges, working capital challenges, and we really buckled down to help them just get the money they needed to support working capital, and they were able to raise $1 million. And as the period has evolved, we continue to work with the company. And just a couple of weeks ago, they were able to now raise growth capital of about $3 million, which is really going to help the business. And they're seeing significant growth, interestingly, because of the disruptions in the supply chain. Kenya is a net importer of fish from China. And this company produces locally and actually has seen their demand grow by up to 40%. So they're seeing significant demand for their product. So the capital has come in at just the right time to really help them meet the needs of the market. We also looked at the incentive payments we were giving. Some of our advisory firms were having a lot of working capital challenges in this period. So we increased the incentive during this COVID period from 1% to 2%. Also to the banks, the commercial banks, we increased the incentive period. We noticed that the domestic banking system really dried up in terms of lending. Our lending by financial institutions went down by 40%. So we increased the incentive to encourage them to continue to look at lending opportunities in this difficult time. And then our advisors also work closely with the companies to remodel their financial projections, do additional market analysis that really helped companies to be able to present their case to investors and provide comfort to investors. As had been mentioned earlier, in Kenya, as we've had an easing of restrictions, the economy has started to pick up again, not to the level that, of course, pre-COVID, but we're beginning to see companies now establish some level of stability, and investors are now coming in. And I think that also helped us to have the impact that we had in terms of helping companies raise money during this period. Just some quick examples of companies. We have a company there that's in the nut trade, fair trade nuts. We have another company, Sun Culture, that's in irrigation and technology for smallholders. They were able to raise 8.5 million in equity investment. Again, these are investors that are looking long-term. Victory Farms, $1 million in bridge finance. Synergy, a waste, organic fertilizer and waste company, had significant challenges early on, but have been able to raise $2.6 million to help in their growth. Komaza is an agro forestry company, was able to raise a significant amount of capital, $27 million. That's really unique, but they have a long-term vision, and investors really bought into their vision for the long term. Another macadamia nuts exporting company, exporting to the US and other parts of the world, was able to raise $1 million debt and still continue looking for equity. A dairy, a modern processor, able to raise $2 million. And then we have an agricultural supply chain platform that provides last mile distribution services as well as business intelligence across the supply chain, and able to raise $3 million in working capital. And a textile manufacturing company that exports to the US was actually able to retool their business during COVID to manufacture PPE equipment. And one of our advisory firms helped them raise domestic capital, about $700,000, which really helped them to support the manufacture of PPE equipment. That was really helpful under COVID. One of the examples, this is a dairy that we supported. They collect, just to show the impact of some of these companies that they have in the market. This company collects raw milk from 10,000 farmers. It serves over 30,000 liters, and they really focus on the poorer segment to informal settlements, and they use an innovative dispensers. They don't use the expensive packaging. Individuals can buy their milk through retail outlets. in the informal settlements. This new investment that they recently got will help them to source from additional 30,000 farmers. And their plan is to increase their payments from 1 to 2, which will really help with farmers' cash flow. And some of the work provided by the advisors was the investment memorandum and teaser, doing market analysis, updating the market analysis to give comfort to investors. Interestingly, this company has been growing even under COVID, so that helped provide confidence to investors. And also to retool some of the financial modeling and forecasting to help investors understand the business model going forward. So some of the lessons that we're learning after the first 2 years is that there is a role, helping companies actually structure transactions on the demand side. There is a role, and the market needs good structuring advisors that can help provide the right information, the right linkages to financial institutions and investors that can do analysis that is critical. For example, Komaza, a critical element of the analysis was a very complicated valuation of the forestry business projected going forward the next 30 years. And our advisors really helped to structure and do that valuation that gave confidence to investors. So there is some appreciation of this value in the market, and companies seeing the value and willing to pay increasingly. Of course, it's still early stages, but there is definitely appreciation we're seeing for the support. The deal closure rate is about 15% of our pipeline value. We've noticed that it takes some time, significant amount of time. In some cases, it's much faster. In other cases, it takes time. And that's something that we're looking at to see if there's any way we can facilitate faster deal closure. But we recognize that, if only 15% of the companies in our pipeline are getting finance, there's still a huge need. And companies, there's a lot of issues related to investment readiness, a lot of issues related to, I'll talk about it further down, having products that financial institutions that fit the needs of growing companies, that fit the needs of companies with less collateral, that fit the needs of companies in risk sectors. So there's still a lot of work to be done, both on the supply and demand side, to facilitate more increase to capital in this market. And COVID, of course, had a big impact. But even with COVID, what we learned is that it's still possible if companies have the right structure and plans for them to raise money. So that's the end of my presentation. Just on a light note, the president visited one of our stands at last year's AmCham Summit and was looking at some of the companies that we've been working with. So I'll end my presentation. Thank you.
Yeah, great, John. Great job, John. Wonderful presentation of the activities in Kenya through the investment mechanism project. We have a number of questions. The way we're gonna run is got a question or two right now. Then we'll switch over to our panel discussion, and Amy will help everyone get mics on, cameras on, and so forth. And then we have a series of questions for our panel discussion. So John, just to finish off this segment, I wondered if you talk about the private sector, because you're obviously filling a huge need for the food processing. Think of food processing in ag space. How does the private sector look at that space, and what is the failure that makes Kim necessary?
Yeah, so I think the food processing is quite a diverse business. In Kenya, we have the feed, we have poultry business, we have dairy, we have ag, fruit processors. So it's quite diverse. There's growing consumer demand, and there's a huge need for produce coming into the market. There's also a growing export market. So it's definitely a growth industry. What we find is companies are coming in now, what we'd call early and mid-stage companies, entrepreneurs coming in with the idea, but they need really the capital to help them to do the right investments in the processing equipment, as well as to structure their businesses in the right way. And because of the demand, they're growing quite fast. They need capital, but the understanding of these sectors by financial institutions isn't keeping up to pace with the needs of some of the companies. So there's a need for, and also there's a need for support to help present the opportunity in the right way to investors and financiers, to help them understand. And that's really the gap that Kim is coming in, is really to create a stronger market for, on the one hand, advisors and companies that are able to help the new companies coming into the market to structure and raise money. On the other side, also helping financial institutions and investors to better design products that will finance some of these emerging companies coming in the food industry.